The bombs hadn't even stopped falling. It was February 24th, 2022. Russian tanks crossed the Ukrainian border at dawn. Cities shook. A refugee crisis was already beginning. And within 48 hours, the S&P 500 had recovered almost all of its losses and was heading back up. Let that sit for a second. One of the largest land invasions in Europe since World War II. And Wall Street basically shrugged. If you've ever watched a war break out on the news while your portfolio ticked green, you've probably felt something uncomfortable. Something that doesn't quite make sense. Markets are supposed to reflect the real world, right? Pain, uncertainty, death, these are not good things. So why do they so often send asset prices higher? Today we're going to answer that. And the answer is going to make you see financial markets, and maybe human civilization, a little differently than you did before. Let's start with what most people assume. The common belief is that markets hate war. That conflict equals chaos equals sell everything and hide under your mattress. And on the surface, that logic seems solid. War destroys infrastructure, it disrupts trade routes, it kills workers, burns crops, blows up factories. It is, by almost every measure, an act of economic destruction. And yes, in the very first hours of a conflict, markets usually do fall. When Russia invaded Ukraine, U.S. futures dropped over 2% before the opening bell. When Iraq invaded Kuwait in 1990, the Dow fell nearly 10% over the following weeks. On September 11, 2001, the New York Stock Exchange didn't even open. When it finally did, 6 days later, the Dow fell almost 685 points in a single session. So markets do panic. At first. But here's the thing. That panic is almost always temporary. And what comes after it is the part nobody talks about. After September 11th, the market recovered everything it lost within a month. After the U.S. invasion of Iraq in 2003, widely considered a destabilizing geopolitical catastrophe, the S&P 500 went on to gain over 26% that year. After Russia invaded Ukraine in 2022, U.S. stocks spent most of the rest of that year falling, but not because of the war. Because of inflation and interest rate hikes that had nothing to do with the tanks. So the pattern, when you look at history carefully, is something like this. Markets drop sharply when war begins, recover quickly, and in many cases outperform over the following year. Why? To understand that, you need to stop thinking about what war destroys and start thinking about what it creates. War is, among other things, a massive government spending program. When a country goes to war, its government starts writing very large checks to weapons manufacturers, to logistics companies, to fuel suppliers, steel producers, satellite operators, software contractors, private security firms. In the United States alone, the defense budget in 2023 was over $850 billion. That's not a typo. $850 billion. More than the next 10 countries combined. And when that money moves, it moves into the economy. It creates jobs. It funds research. It builds supply chains. It generates contracts that cascade through dozens of industries. There's even a term for this. Economists call it the military Keynesian effect. The idea, loosely, is that military spending acts like a government stimulus, injecting money into the economy during times when private investment might otherwise pull back. This is uncomfortable, because it implies that one of the most reliable economic boosts in modern history has come from preparing to, or actively, killing people. Now let's talk about who specifically benefits. When the U.S. got involved in Afghanistan after September 11th, defense contractor Lockheed Martin's stock eventually climbed more than 1,000% over the following 2 decades. Raytheon, which makes the missiles used in nearly every modern U.S. military engagement, saw its valuation surge during the early days of both the Iraq and Ukraine conflicts. When Houthi rebels began attacking shipping in the Red Sea in late 2023, Raytheon's stock jumped because, you guessed it, more missiles would be needed. The industry has a name for this. They call it the threat environment. And the worse the threat environment gets, the better business becomes. Here's where the irony sharpens to a point. Some of the world's most profitable companies are structurally designed so that peace is bad for their revenue. Not because their executives are evil, but because that's how the incentive system works. Conflict equals demand. Demand equals earnings. Earnings equals stock price. And stock prices are what markets measure. But it goes deeper than defense stocks. War reshapes entire industries in ways that echo for decades. Take oil. Wars in oil-producing regions, the Gulf, the Middle East, Russia, create supply disruptions that send energy prices surging. When energy prices surge, energy companies profit enormously. And energy companies are massive components of most major stock indices. So a war that spikes the oil price can actually lift an entire index. Take commodities more broadly. Ukraine and Russia together produced roughly 30% of the world's wheat before the 2022 invasion. When the war started, wheat prices jumped over 50% in weeks. Who benefits from expensive wheat? Agricultural companies. Commodity traders. Fertilizer producers. Again, sectors sitting inside the indices your retirement fund is probably tracking. Take technology and cybersecurity. Every modern conflict now has a digital dimension. NATO countries began dramatically increasing cybersecurity spending after Russian interference campaigns. That money went somewhere. It went to publicly listed tech firms. The pattern is always the same. Destruction in one place creates demand in another, and markets are very good at finding the demand. Here's the uncomfortable math. Markets don't price the world as it is. They price the world as it's expected to be. Specifically, they price expected corporate earnings. And corporate earnings are a function of revenue and costs, not of human welfare. If a missile strike destroys a Ukrainian city, that is a human tragedy. But on a spreadsheet inside a defense contractor's quarterly report, it becomes a unit of demand. If a sanctions regime blocks Russian gas from Europe, Europeans freeze. But on an energy company's balance sheet, it becomes a pricing opportunity. This is not a conspiracy. Nobody sat in a room and decided to make money off suffering. It is simply what happens when you build a system that optimizes for one thing, return on capital, without building in any mechanism to account for everything else. Markets are ruthlessly, almost beautifully indifferent to suffering. They do not hate war. They do not love peace. They love clarity. The number one thing markets fear is uncertainty. And paradoxically, the outbreak of actual conflict often reduces uncertainty. Before the invasion, nobody knew if Russia would actually cross the border. Once they did, the uncertainty collapsed. The range of possible futures narrowed. And markets, strange as it sounds, found that calming. Now contrast that with the narrative most people absorb. Watch financial news coverage during a geopolitical crisis and you'll hear the same phrases recycled endlessly. Markets are rattled. Investors are nervous. Volatility surges as tensions mount. And yes, those things are technically true. For a few days. But the framing implies that war is structurally bad for markets. That conflict and financial performance are in opposition. The data says otherwise. A study analyzing U.S. stock market performance around every major military conflict from World War I through the War on Terror found that, on average, the market was higher 1 year after the start of conflict than it was before. Not always. Not in every case. But on average. There's something almost darkly poetic about that fact. We have built financial systems so intertwined with the machinery of war that, statistically, conflict has been net positive for portfolios. But here's where we need to zoom out. Because none of this means war is good for economies in any complete sense. The benefits we've been discussing, the defense spending, the commodity price spikes, the security contracts, these are visible. They show up in earnings reports and stock prices. They're measurable. The costs are mostly invisible to markets. The human capital destroyed. The infrastructure that must be rebuilt from rubble at enormous expense. The generational trauma that reduces productivity for decades. The refugee crises that destabilize neighboring economies. The institutions eroded. The trust between nations dissolved. Economists who study the full costs of war, not just the immediate GDP effects, consistently find that the long-run damage is catastrophic and almost never fully captured in market prices. Because markets discount the future, meaning they care much less about something happening in 20 years than something happening next quarter. War's benefits are front-loaded. The contracts, the spending, the commodity prices, those come quickly. War's costs are back-loaded. The reconstruction, the instability, the institutional decay, those come slowly, often across generations. Markets are short-sighted by design, so they see the benefits and miss the costs. And then there is the biggest risk of all, the one that doesn't fit neatly into any model: major escalation. The reason markets recovered quickly after most 20th and 21st century conflicts is that those conflicts, however terrible, remained contained. The U.S. economy was never bombed. Western financial infrastructure was never directly targeted. The dollar remained the world's reserve currency throughout. Global trade slowed but never stopped. That calculus changes completely if a conflict escalates to involve major economic powers directly. A war between the U.S. and China, for instance, would not produce a 2-day dip followed by a recovery. It would produce a restructuring of the entire global economic order. The supply chains that currently make your phone, your car, your medication, many of those run through or depend on stability in the Pacific. No model handles that well, because no model has experienced it. The markets rally during war because they're gambling that the war stays manageable, that it stays someone else's war. The moment that assumption breaks, the rally ends. So where does that leave us? Here is what we know. Markets are not moral. They were never designed to be. They are information aggregation machines that reflect collective bets about future corporate earnings. And those bets, over and over again in history, have concluded that war, for certain companies in certain sectors, over certain timeframes, is profitable. Here is what that tells us about financial markets themselves. They are extraordinarily good at pricing narrow, near-term, measurable outcomes. They are extraordinarily bad at pricing broad, long-term human outcomes. And here is the question that I'll leave you with, because I don't think there's a clean answer. If the system that allocates capital in our economy consistently rewards the machinery of war, not because anyone wants war, but simply because that's where the earnings are, then what does it say about us that we've built it that way? And more importantly, what would it take to build it differently? The tanks are still rolling. The missiles are still flying. Somewhere right now, a defense contractor is revising its earnings forecast upward. And the market is watching. And the market is satisfied.